All right, so chapter 9, plant assets. Natural resources and intangible assets. Okay, and you'll probably hear me say not plant assets, but plant property and equipment, or PP&E, because that was my book used plant property and equipment. So I fall back to that all the time. The bottom line is, though, we're always talking about plant assets. We're talking about items that are used for more than a year. They're long-term assets, and they're used in the operations of the business to produce a product. They're usually one of the biggest investments a company makes. And they talk about that on the top of page 398. There's 3 characteristics of a plant asset. One is that it has a physical substance, so you can touch it. It's a piece of equipment, it's a piece of land, it's a building, it's a car, it's a truck, it's a piece of machinery. It's something that you can actually tangibly work. They talk about it being used in the operations of a business, so you use it to provide a service or to make a product or to sell a product. So in a store, the shelves that they have set up to display their merchandise, that's an example of a plant asset. And then the third item is, it's not held for sale or intended for sale to customers. That would be inventory. So for example, if I am a furniture company and I have a delivery truck, the delivery truck is a plant asset because I use that delivery truck to deliver sales to customers. I use it in my operations. But if I'm a automobile dealer and I have a delivery truck that I have that I'm going to sell to somebody who wants one, that's an inventory item because I'm going to sell it hopefully in less than a year. So that's the only distinction there. They talk a lot on page 398 and 399 about how to determine the cost of plant assets. And again, they're typically one of the bigger expenses companies make. And so we want to make sure we get that right. It's a cost is basically everything, not just the price you pay for the product, but or the plant asset. It's also everything you need to get it ready to be used. And so, for example, they go through and they talk about land. And so, if we're talking about land, it's going to be the purchase price, okay, what you pay for it. But in addition to the purchase price, you're also going to go through, you're going to have any closing costs that you have to pay, because that's a cost of getting it. So closing cost for land would be part of the cost. It's what we call the basis, is another term for it. Any brokerage fees that you pay, so commissions, real estate agent fees, okay, that you had to pay as the buyer would be included. If you had any property taxes, not normal ongoing property taxes, those were operating expenses, but when you bought the land, if it had property taxes and you agreed to pay those as part of the price of buying the land, then that would be part of it. So any accrued property taxes. So all those become part of the purchase, part of the cost. But then also there's some other things you can go through. For example, if you go through on land and you buy the land, but then you have to do some grading or preparation on it to get it ready to be used, then that's a cost. So you'd go through and have things like expenditures for clearing or grading. What are some of the others? Draining. Drainage, putting in drainages, okay? Or filling. I don't know, have you guys ever taken any classes over at College of the Canyons? You been to that campus? Oh my gosh, the amount of grading they had to do, because those were basically hillsides. I mean, they cut stuff down and filled things in. I never want to be over there in an earthquake, because that place is going to rock and roll like jello.
And it's really great
I didn't say that.
raining.
When it's raining, yeah, the water's running all over, and it's just, yeah. But I mean, there was just a tremendous amount of grading they had to go through and do to get that done. Okay, and then they pack it down. It's safe, I mean, but it's still going to rock and roll because Phil always rocks in their earthquakes. So that would be something you would add to the purchase price and all the purchase closing costs. Another thing you might have on land, again, this is all land we're talking about, would be if you had bought some land and it had an old building on it, or it had old construction and you had to tear that down. So you would have demolition cost of old buildings and removal of old buildings. Now, if you had an old building and somebody came in and said, we'll tear it down, we'll give you $10,000 to take parts out of it, you'd reduce that cost by the $10,000 that you got for the salvage. Okay? But the bottom line is land's not just the price you paid for it. There's a lot of other pieces that can be added into land. Okay. And so anytime you're looking at any type of a plant asset, it's going to be included in all these costs. They also talk about equipment. Actually, before we get into equipment, let's do land improvements, okay? Now, there's a distinction, and sometimes it's kind of hard to know the difference. This is land. Now, land improvement would be like you put a driveway, or you put a fence, or lighting or landscaping, okay? We don't include that in part of the land. Why is that?
Because they're all things that will eventually break down and you'll have to redo them.
Exactly. All those items that are called land improvements are things that eventually are going to have to be replaced. We're going to eventually have to replace the lights because they're going to wear out. We're going to eventually have to redo the driveway or the parking lot because it's going to need to be redone. We're eventually going to have to replace the fence because it's going to rust or it's going to fall apart. Land is something that we assume is not going to change. As a matter of fact, we talk about depreciation. Land is not depreciated because we assume that it's not going to decrease in terms of its usability over time. But the other items are going to decrease in their usability. So if we go through and we're doing a bunch of grading and we're doing a bunch of preparation like they did over at College of the Canyons in the campus in Canyon Country, all this would be land, but the lights they put in and the pads they had for the buildings that they put down, the concrete pads with the utilities and the parking lots, all those were land improvements, and they were recorded separately from the land because those have an estimated life where we think they're going to wear out. Now, it might be 40 years, but we think at some point we're going to have to replace them. Another major plant asset are buildings, and we don't talk about it in this book, but if you buy a piece of land with a building on it, you actually have to split off how much of the cost was for the land and how much is for the building for the same reason. We assume that the building eventually is going to be worn out. It's going to be used up, and so we're going to have to replace it. So the building we're going to depreciate, the land we're not, so we have to split them off, but we don't do that here. But in the building we go through and we keep track of that. If you have to go through and you buy a building and the roof's bad, and before you move in you actually replace the roof, that can actually be added to the cost of the building. Now later on, if you move in and you're there for 5 years and you replace the roof, then it might be an ordinary repair or capital or revenue expenditure. We'll talk about those. But if you do it at the very up front when you buy the building as part of the remodeling costs and everything, that's all part of the cost of the building. You add it into the purchase price. On the bottom of 399, they talk about the equipment. Now, the equipment is where it actually gets to be kind of interesting because when you have equipment, usually we think, oh, we're going to just pay what the purchase price is, right? So that's going to be the purchase price. But in addition to the purchase price, it's also going to include any taxes that you have to pay. So if you had to pay sales taxes, that's going to be added as part of your purchase price. Okay. If you go through and you have any sort of freight that you have to pay to get it there, you're going to add that in. So let's suppose that you're a manufacturing company and you bought one of those big $3 or $4 million electronic presses that you need to stamp metal. All right, it's going to cost a lot of money to get it there because it's got to be hauled in on a truck. You have to have a crane that's going to lift it up and set it onto its pad. All that's going to be part of the cost. You're also going to have any sort of a insurance that you might have in transit because those things are big, and so you might have to pay a special insurance to get it to the location. So if it falls off the truck and rolls over a car, you get sued, that it'll be covered. So all those are part of the cost of acquiring the asset. In addition to that, you're also going to go through and you can add in the cost of pad preparation. So remember I said you're going to put that big, heavy press that you're going to have to bend the metal. You're going to put it on a pad that's been prepared. The cost of building that pad and preparing it and installing the electricity that you need to run that thing, all that's going to be part of it. So that's going to be installation cost. So all those costs go into the cost of the equipment. And then also, if there's any testing that needs to take place. So once you get it, you go through and you have people come in and they have to run through and do a bunch of testing to make sure it's working properly, make sure it's calibrated. That's part of the cost. So it's not only the purchase price, it's also the price of anything that's necessary to get the asset ready for its intended use. So many times purchase prices on equipment, on land, on buildings are a lot more than what people think. It's more than just what they paid for it. So you really need to kind of go through. You should be comfortable knowing what these items are. I'm pretty sure you're going to have to know this on the test several different places. So be aware of what's included in purchase prices of land, equipment, buildings, and land improvements. Okay? On the bottom of 400, they talk about expenditures that are made during the useful life. So now you bought something, and you've been using it for a while. And now you've got to spend some money because you've got to fix something. Well, does that become an ordinary expense, or does it become a planned asset item? And that depends upon a couple of things, okay? First, well, the first thing it depends on, let's just do it based upon the technical approach. It depends on whether you have something called an ordinary repair, which is also called a revenue expenditure, or whether you have something that's called a, what they call that here, addition and improvement, which is what we call a capital expenditure. Now, what's the difference? Well, an ordinary repair is something that's necessary to, how do they phrase it, to maintain operating efficiency. So here you're going to maintain operating efficiency. On an addition or improvement, you're going to do just that. You're going to go through and you're going to increase something. You're either going to increase the operating efficiency, or you're going to increase maybe the useful life. Because of this, you're going to have it longer. So the useful life, which is how long you plan to use it. Maybe you're going to increase the capacity. It's going to become more productive. So increase productivity. If it's a capital expenditure, this is going to be added into planned assets. If it's a ordinary repair or revenue expenditure, it's going to be expensed as an operating expense when you incur it. So let's give you a couple of examples. They don't do it in the book, but I like the example of the truck. Okay, you go through and you have a delivery truck. And what you do is you maintain it by doing repairs on it, right? You replace the tires, you tune it up, you get oil changes and all that. That's what you need to maintain it. So if you spend the money, that's going to be the cost of maintaining it. That's just going to be treated as a repair cost. And you're going to debit repair expense, credit cash, and it goes on your income statement. But how about if you go through and do something that's going to make it last longer? So maybe you go through and you decide the motor's going bad, and instead of getting it at the end of its life, you say, I'll put a new motor in it and I can use it another 5 years. That would be a betterment. That would be a capital expenditure. So the cost of putting that motor in would become a capital item. Or let's suppose that it's a delivery truck and you've been going through and people have been lifting things up in there, it's kind of heavy, and you say, hey, how about if we put one of those power lift gates on the back? Those are pretty cool. Well, that power lift gate is a capital improvement because it increases the productivity and efficiency. So the cost of adding that power lift gate would be a capital improvement, and you would record that as a planned asset. Okay. So this kind of gets into where sometimes people mess things up and they spend some money that should be down here, but it could be an ordinary repair. Now how about a roof? How about if you have a building and the roofs should last, you know, it's one of those tar roofs, they last about 10, 15 years. And it's been on there for 12 years, and now you have to put a new roof on it because it's starting to leak. Yeah, that's maintaining the building. So that would be a revenue expenditure, and it would be recorded as an expense in the current period. But what if you say, you know, we need to put a new roof on, so let's do this. Let's put a new roof on, but let's put on a metal corrugated roof, and we'll put new insulation in that's going to save the air conditioning cost, and it's going to last longer. What would that be? that would be an improvement, okay? And that would be recorded as an addition to the capital asset. You'd add it to the cost of the building. Okay. So again, sometimes it's a little gray, you have to kind of work through it. The second item you use besides these is you use something called materiality. And the idea is, sometimes you buy something and even though you should keep it because it's going to last a long time, it's not worth messing with. So, you know, obviously if I buy a delivery truck and it's going to last 10 years, I'm going to record it as a capital asset. But suppose I buy a really nice trash can and I spend $50, which is a lot of money for a nice metal trash can. It might last 10 years too. But am I going to want to record that as a capital asset and depreciate it over the next 10 years? No, it's more trouble than it's worth. It's not cost effective to do that. So even though it's technically a capital asset or capital expenditure or a plant asset, I'm going to just write it off because it's not that big a deal. So small expenditures oftentimes that would be plant assets are written off. This GoPro camera, okay, technically it might last several years. So if I was a business, I might argue that should be something that should be capitalized. But you know, if I buy for $200, I might have a rule that anything under $250, I just expense because it's not that big. Okay. So materiality, they talk about that. Many businesses have a materiality limit on when they're going to record something as a plant asset. Okay. So knowing the difference between these, I'm pretty sure that's going to pop up on the test in a place or two. Then over on page 402, they start talking about something called depreciation. Now, we buy these assets, and this is great because we're going to use them in our business, but we also know that as we use them, they're going to start to reduce in value. Now, depreciation is not a way of valuing what you think things are worth. It's not a valuation method. What it is, it's a cost allocation. We know as we use up that delivery truck that we need to figure out how much of that cost of having that delivery truck is matched properly against the revenues that we generate when we're using it. So depreciation is a way of allocating the cost of these plant assets over the time period that we think we're going to use them, which we call the useful life. So the whole purpose of depreciation is a cost allocation method. And it's not a valuation. Sometimes people think, well, we're depreciating it, and that's going to be what we think it's worth in the marketplace. Because we think of when we buy a car, you know, the car's depreciated, and that means they're worth less than we bought them. But in the accounting sense, depreciation isn't what something's worth. It's how we're allocating the cost. You know, we have an asset that we think is going to have a future economic benefit to us, but as that building, as that truck, as that piece of equipment is used through wear and tear and obsolescence, it becomes worth less and less in the future because eventually it's going to need to be replaced. So how do we show that asset being used up in a systemic and proper way that's allocated over the time we're going to be using it? And that's what depreciation is. And again, just for the point, land doesn't depreciate because we assume the land doesn't get used up. So, but everything else is going to be depreciated, whether it's a leasehold, a land improvement, a building, or whether it's a piece of equipment. What else do we talk about? Let's see. There's different ways to record depreciation. They make the point that recording depreciation doesn't mean you're setting money aside to have cash in the future to buy a replacement. That's a different process. So when you record depreciation expense, you're not putting cash in a bank so you have money to buy your next piece of equipment. You're just showing the expense in your income statement for the use of that piece of equipment for that period. There are different ways we calculate this, and they talk about this on page 403, the factors in computing depreciation. There's different methods, and we want to use the method that best matches how that asset's being used to provide a revenue. So we want to match the expense of that asset to the revenues it's generating. So the method that we use can differ based upon how that asset's going to be used up. And how do we figure that out? Well, there's three factors they talk about here. One, we factor in, so these are the three factors for depreciation. One that we use is the cost. So we just talked about that. We want to know how much we paid, including all those installation costs or costs of getting the item ready to use. The second one is the useful life. And the useful life is how long that we think that the asset is going to be used in our operations. And usually it's measured in years because we're talking about assets that are going to last more than a year. So the useful life is our estimate of the estimated productive life. It's also called the service life. And that can include not only wear and tear, but it can also include obsolescence. Sometimes you have an asset that still works perfectly, but it's obsolete. You know, I've got a couple of old computers at home that I could plug in and would run fine, but you know, they're running like iOS 5 or Windows 3.1. They work fine if anybody remember how to use that stuff, right? But they're obsolete because they don't work with anything else. So, but they still work fine just like they did that day, it's just they became obsolete. The third factor that you have in here on your depreciation is what they call the salvage value. And this is what you think you're going to get at the end. Sometimes you'll hear it called the residual value as well. Okay. And that's what you think when you get to the end of the estimated useful life. If you think you can sell it, then you have to estimate what that is. Maybe the value is 0, you're going to wear it out, in which case you would have no value. But if you think you're going to sell it for something, then you have to estimate that. Now, the different methods that you use, they talk about over on 403, and then they illustrate on 404, 405, 406. There's the straight line method, there's the units of activity method, and the declining balance method. You're going to need to know how to calculate all of these on the test. So what I want to do is kind of walk through and figure out and show you how to do these. And again, we're trying to select the method that best measures an asset's contribution to revenue over its useful life. The very first sentence on 404. So all of these are acceptable methods, just you have to pick the one that you think is best. So let's start over here with the straight line. It's by far the most common method, okay? 90% of the companies use the straight line method. It's simple, it's easy, and it actually does a pretty good allocation of the cost. If you think your asset is going to be used up pretty equally over time, then this is a way it's going to spread those costs equally over time. So when you do the straight line, what you're going through and doing is you're looking at the cost, and you're finding something called the depreciable base. So what's the depreciable base? Well, on all these, you're going to be depreciable. Okay, you're going to do the depreciable base, which is going to equal the cost minus the salvage value. Okay. So in this case, we have a piece of equipment that we paid $13,000 for. And we think at the end of the term, we're going to be able to sell it. At the end of useful life, we can sell it for $1,000. So that means that we're going to use up $12,000 of that asset. That becomes our depreciable base. So that's what we have to figure out how to allocate over the time period. Now, the depreciable base or depreciable cost, how long do we think it's going to last? Well, this is an estimate. You're going to have to look at it and see how long do we think these types of assets typically last. Maybe we're going to use it heavy, we're going to use it faster, maybe we're going to use it as much, it's going to last a little longer. In this case, we've come up with an estimate of useful life for 5 years. So what we're going to do is we're going to go through and we're going to divide that by 5 years, because that's our useful life. So that means each year the amount of depreciation we have is going to be $2,400. And that's our annual depreciation. That's the expense that we think that this building, this piece of equipment is going to cost us. Okay? So that's all you do in the straight line. Now, you can show a little calculation. It's a good idea to know how these work, because in addition to knowing the annual expense, you also want to find something called accumulated depreciation. You want to find something called book value, because you need to know those at different times during the asset. So let's go through and let's talk about how we do the calculation here. So if I've left myself enough room, it's really hard, it's kind of in the way. Let's do the year here, okay? So we have 2017, 2018, 2019, 2020, and then 2021. So what we have are 5 years, and we acquired it in 2017. So we're going to go through and we're trying to find our depreciation for the year, so our depreciation expense, we also want to go through and show our accumulated depreciation, which I'll abbreviate as accumulated depreciation, And then we finally want to show something called the book value. Now, what we're going to do, we've already found our depreciation expense for the year. What is it? It's $2,400. Is it going to change? The nice thing in the straight line is it's going to be the same every year. That won't be the case in the others, but this one is easy to fill in. And again, if you wanted to do it the way they've got here, you just take your base of 12,000, which is what we had here, and you multiply it by 20%, and that gives you your 2,400. Now, where's that 20% coming? That's my depreciation. That's my rate, right? And so the way that we calculate the depreciation rate for straight line, SL for straight line, is we take 100%. That's what we want to allocate, and divide it by the number of years, and that works out to be 20% a year. Okay? So that's another way we can do it. Okay? If you wonder where the depreciation rate came from, that's what it is. So we would do this, and this would be exactly the same calculation every year because, of course, we have 2,400. The accumulated depreciation, that's all the depreciation we've taken in previous periods. So at the end of the first year, we've taken 2,400 in accumulated depreciation, so how much accumulated depreciation do we have for all the years? We have 2,400, 1 year's worth, right? The book value is what we show the value of the asset on the books. It's always going to be the original cost minus the accumulated depreciation. So if we paid $12,000 for it, actually we paid $13,000 because it's going to include the salvage. So it's going to be the cost of $13,000 minus $2,400. Our book value is going to be $10,600. In other words, we're saying we paid $13,000 for it, but we've used up $2,400 of the asset through the depreciation. So we think there's $10,600 worth of the asset left, of value in the future left for us. And so as we go through every year, we add the new annual depreciation to the accumulated depreciation. So the second year it's going to be $4,800. And then we subtract the $4,800 from the $13,000 cost, and that gives us a book value of $8,200. We add another $2,400 for the third year. That means we have 3 years worth of accumulated depreciation, so that's $7,200 of depreciation we've written off. Well, we started with 13, we've taken 7,200, so we must think that there's 5,800 worth of value that's still left. That's the book value. And you just keep repeating this. 2,400 added on that is 9,600. Subtract that from the cost of 13,000, that's 3,400. And then finally, the last year we take depreciation, that comes up to 12,000. We subtract that from the 13, and we think the book value is $1,000. Hey, guess what? Where's that $1,000? Doesn't that sound familiar? Isn't that what we thought the salvage value was, right? So if we've done everything right, when we get to the end of the useful life and we've done the depreciation, the book value should always equal the salvage value. If the book value is 0, then the salvage value is 0, then the book value will be 0. Okay. So that's straight line. It's the most simplest to use, it's the most common, and it's the one that you're probably going to see the most frequently. Okay?
How did we get the 10,600 book value?
We got that by taking the 13,000. We took the cost, 13,000, minus the accumulated depreciation for the first year of 2,400. We subtracted that, and that gave us our book value, which was the 10,600. And then every year, as our accumulated depreciation went up, we just subtracted that new number from our cost, and that gave us our ending book value. Another method that gets used, this allocates the costs over time. Another method is an activity method. It's called the units of activity, and it allocates the cost based upon the usage. So it might be better for something where you're going to run a machine for a number of hours, or you're going to drive a delivery truck for a number of miles, or you're going to fly an airplane for a number of hours. And so the more hours you have, the value goes down based upon the usage more than just the time. And so the units of activity is kind of the same thing. first thing we need to do with that, though, is we need to find out how many units of the activity or what the activity is. So over on page 406, they talk about that. This is a, what is this, a truck? It's a delivery truck, okay? And so they've gone through and they said, you know, this delivery truck, we think it's going to last for 100,000 miles. And it's the same one over here. Boy, you didn't pay very much for it if you paid $13,000 for delivery truck, right? But so we had our cost was $13,000. And then we had our salvage value was 1,000. So that meant that our depreciable base was the $12,000. So that part's the same as what we had in the straight line. What we do here then is we take that depreciable base and we divide it by 100,000 miles. And if we do that, that works out to be 12 cents a mile. So we figure every mile we drive this asset, this truck, it's going to go down in value. We're going to use up 12 cents worth of it, which kind of makes sense. So then once we've done that, then we need to know what the mileage is that we're going to drive every year. So again, on 406, you can kind of see the same depreciation schedule. We start off with 2017, 2018, 2019, 2020, and 2021. And here we have the units. And that's how many miles. And so somebody has to estimate that. They say we're going to drive 15,000 miles the first year, 30,000 the next year, 20,000, 25, and then last year we're going to drive 10,000. Now we're going to go through and we're going to multiply it by 12 cents. And that's going to give us our depreciation expense. So 12 cents a mile times 15,000, that's $1,800. That's our expense for the first year. So we would debit depreciation expense for $1,800, and we're going to credit accumulated depreciation because we show that amount that we're adding into the accumulated depreciation as a offset. It's a contra account, and it's subtracted on the balance sheet from the value of our assets. So this one here, 12 cents times 30, that works out to be $3,600, $2,400, $3,000, and $1,200. So that's how you find the expense. So that's just what we did here, only straight line, it was the same. You can see in the periods we're using it more, we're putting a higher expense. That kind of makes sense. The periods that you use an asset more, you're going to use up more of the value, so you should have a higher expense. And then we're also going to go through and do the accumulated depreciation. And then we're going to use that to find the book value. So the first year accumulated depreciation was the amount of depreciation we had, the $1,800. We're going to subtract that from, again, the cost of $13. You don't use the depreciable base, you use it from the cost. So 1,800 less 13,000 is 11,200. And then we just keep adding the depreciation expense for each year to the accumulated base. So the next year, 3,600 plus 18 is 5,400. Subtract that from the cost of 13,000, and we think the book value is 7,600. Same thing, add 24, that gives us 7,800. Subtract from the 13 gives us 52. Add 3,000, that's 10,800. Book value would be 2,200. And then 1,200, that would be 12,000. And guess what? 12,000 from 13 gives us 1,000, and that $1,000 is equal to our salvage value. So that would be our depreciation schedule for this item. Now obviously we don't know, that's our estimate, we don't know in advance what it's going to be. In 2019, if we ended up driving 22,000 miles, we take 22 times 12. But for purposes of calculating it out now, we use the estimates. Okay. So this gets used a lot where we want to try to match the cost of the asset, where the activity varies from year to year. This is a more accurate way of matching it for activity levels. Okay. You're going to need to know how to do that one too. Any questions on this one? Because I'm going to erase it and do the next one. So that's units of activity. The next one is what we call an accelerated method, meaning it's going to result in higher expense in earlier periods and lower expense in later periods. So we're going to talk about something called the declining balance method. And this is on page 406 and 407. So declining balance method. And you might use this where you have an asset that the value is going to be greater in the early years and then it falls off later on. Maybe technology changes, so in the early years it's real useful, but later on, because it becomes obsolete, it's not quite as valuable. So you might use it there. In the declining balance, there's a couple things you're going to do different. Okay? First off, you're not going to worry about the salvage value right now, because we're going to calculate the depreciation each period based upon book value. So we're going to ignore the salvage. So that's the first thing. We're going to ignore salvage up front. The other thing is we have to apply some sort of a rate. And that rate's going to be driven probably off of our straight line. They talked about something called a double declining balance. That means it's double the rate for the straight line. So what you would do is you would find what your straight line rate is, and then you would use that to calculate what your declining balance would be. So if we're using double declining balance, DDB, and we have an asset that we're going to use for 5 years, the straight line rate would be 20%, right? So we would take 20% and we're going to double that. That means our rate's going to be what? 40%. So that's going to be our double declining balance rate. They also have 150% declining balance. You take 150% times a straight line, it would be 30%. So there's different versions of this. Well, this one that's shown here is the double declining, or the 200% method. Okay. So that's where we're going to get this 40%. We took the straight line and we doubled. Then what we do is we go through, and again, we set it up the same way. We start off with the different years. We have 2017, 2018, 2019, 2020, 2021, okay? And now we start with the book value at the beginning of the year. Now, in this case, we're going to ignore the salvage value at the beginning. So this is completely different than the other two. So the cost is what we have is $13,000. That's what we think it's worth. And then we're going to multiply it by the depreciation rate. So that's the 40%. So our annual depreciation, our depreciation expense in the first year is going to be 40% times 13. It's going to be $5,200. Look how much higher that is than the straight line. Okay, it's double. Okay, starting out, it's much higher. Then what we're going to do is we've got to go through and we've got to show the accumulated depreciation, just like we've done before, and then we're going to show the book value. And the book value becomes more important here because that's what we're going to use to calculate the next year's depreciation. So then we have the book value. So the accumulated depreciation is $5,200 because we just had 1 year. And the book value is going to be the cost, $13,000 minus 52, which means we think it's worth $7,800. That's our book value. Okay, everybody with me on that? Now what we're going to do is we're going to bring that $7,800 over here, and that's going to be the base that we then use to apply our next rate. So we again use the 40%. Now we take 40% of the book balance, and the depreciation now goes down quite a bit, $3,120. So it falls off pretty rapidly. The $3,120 gets added to the accumulated depreciation, so now we have $8,320. That's subtracted from the cost of 13 gives us a book value of $4,680. And now we bring that ending book value over, and that becomes our calculation for the next year. We take that times 40%, and now our depreciation has fallen all the way to $1,872. So in 3 years, it went from being double the straight line to being less than the straight line. And that's a characteristic of the declining balance. More expense in the early years, depreciation expense, but less in the later years. We add that to our accumulated depreciation, so 8,320 plus 1,872. That works out to be 10,192. And then now our book value, subtracting that from the 13,000, our book value is all the way down to 1,685. So it's getting pretty low, right? So now we bring the 1,000. I skipped a year, didn't I? 10,192. That's 2,808. There we go. We bring the 2,808 over, multiply it by 40%. Our depreciation expense is 1,123. Add that to our accumulated depreciation. It's 11,315. Now our book value is 1,685. So our book value has fallen down pretty quickly. Now we come over here and we take 1,685 and we multiply that by 40%. But now we got to be careful, because if we do that, what does that give me? Somebody do that. What's 1,685 times 40%?
Give you 674.
Does it?
That's what they have it right there. 674.
Oh, okay, yeah. Okay. They could give me a better example. What we need to do is, we don't want to go, usually what will happen in your last year, if you keep doing that, is you'll end up taking too much depreciation. Because what do we want our ending balance to be? We want our ending balance to be that salvage. So what we do in that last year is we figure out what we need to get from here to here, and we just use that for our last year's depreciation. Now in this case, they actually round it up. More likely, you would calculate it, and that would give you a number of like $900. And if you put 900 over here, you'd end up with something like $750. That would be wrong. So the amount that you need here each year in the depreciation expense is whatever you need to get from the ending year to the salvage value. So in the past, when I've had people do these schedules, and I'll have you do the same thing, where you'll calculate a depreciation schedule using all three of these methods, and you'll find the expense, the accumulated depreciation, the book value. They would do this, they'd calculate the number. When they got over here, they'd end up with the 785, okay? So they would make a mistake, so they'd lose a point because they had the wrong salvage value, and they'd lose a point because they had the wrong depreciation expense. So you've got to remember, this expense is whatever you need at the end to just get to your salvage value, not more, not less. Okay? So you can't ignore salvage value completely. You don't use it at the beginning, but you got to remember it at the end, of course, when it's easy to forget. So that's the accelerated method. Okay? That's called declining balance. The amount of depreciation expense is the same for all three methods. By the time you get to the end of year 5, you've depreciated out $12,000. They're all the same. It's just the timing of when the expense is recorded. And again, we're trying to use a method that best matches how that asset is being used to provide value to the company. You can't use this for taxes. There's actually a whole other system called Modified Accelerated Cost Recovery System. The tax rules have their own tax rule. And they use something that's kind of a blend of the declining balance method and the straight line. We're not going to have to worry about that, but just realize this is for the accounting purposes for GAAP, but it's not for taxes. Taxes uses its own set of rules. Its rules are also included, not using salvage value. They use a declining balance because they put more expense up front in the early years, and they usually use a shorter estimated life than you would in the real world for GAAP because they want to have higher expenses. Why would you want to have higher depreciation expense on your tax return?
That's money in taxes.
Yeah, if you have a higher depreciation expense, that's going to make your income lower. You're going to pay less in taxes. So the focus on the tax side is saving taxes. The focus on the GAAP side for financial statement purposes is matching expense to your revenue for the cost of the plant asset. They talk on bottom of 408 about what happens if you go through and you have a revision. You can actually change your depreciation method. If you go through here and maybe you get 2 or 3 years into it and you realize that, oh my gosh, we're going to use this up maybe faster. So what you do at that time is you take the book value that you have and then you divide that by the amount of the time that's left and you come up with a new depreciation rate. And then you change it for that year and going forward. You don't go back and change the earlier years. Okay. Same thing, if you thought it's going to last longer, you'd take the book value in year 3, and if I think it's going to last 4 more years, I'd divide that by 4, and that would be the amount of the depreciation and expense I would use then for each of the next 4 years. So it's not uncommon to revise your estimates, because again, when you start out, it's your best guess based on your past history, but your actual usage might change. Okay. Now, when we go through and we get ready, maybe we're going to sell some of these things. If we retire them, if we just use this thing up and at the end we're all done with it, and we just don't sell it, we just scrap it, then, or we sell it for the $1,000 for salaries, then we're pretty much done with it. But at the same time, when we get rid of it, we've got to remove it from our books because it's no longer an asset. So we've got to go through and take it out of the plan assets. We've also been recording accumulated depreciation, because when we went through and we recorded this depreciation expense, and if you remember from chapter 3, this was an adjusting journal entry, right? You had to record depreciation expense. You would have debited depreciation expense for $5,200. You would have credited accumulated depreciation for $5,200. Accumulated depreciation is a contra asset account. If you look on the balance sheet, it's subtracted from your total plan assets. So when the asset goes away, we've got to take the accumulated depreciation out as well. Now, if we sell it for the book value, we don't have a gain or loss. But often we'll have a gain or loss, because remember, this is a way of allocating the cost. It's not figuring out what we think it's worth. So when we get to the end, the amount that it's actually worth might be worth more or less than what our book value is. And so when that happens, we have to go through and we have to figure out if there was a gain or loss. So let's look at that on the sale of plan assets on the top of 411. Okay? Let me erase this so I have something to work with.